So you mentioned something about hedging. Why would you need to be doing hedging if you're doing zero DTA trades that are based on spreads? It's already protected.
Because I am running a overnight strategy.
Oh, okay, I got it.
But again, when we go back to the principles here, as you can see here, the overnight strategy is a 30% PCR. So I size this very small. This uses about 10% of buying power. So right now, as we sit here, I've got 90% of the account in US Treasuries, and I have about 10% of the account exposed in terms of buying power. But I also carry more long delta than short delta. It's basically delta neutral. The decay of the 1 DT versus the 1 and 2 week longs is just significantly faster. So basically, by doing this, we've added two diversified return streams that are very capital efficient, and then also offer us, a very high premium capture. So the benefit of, again, running more uncorrelated strategies is if there were to be some very large intraday move, or it was the worst day in zero DT, where we ping pong up and down 30 points and you get double stop, this just decays and you make money. Helps offset that.
So your strategies are either zero DTE. What is the percentage allocation between zero DTE and 1 DTE?
So
do you do anything else besides those two?
Yeah, so these are a conglomeration of 20 strategies between these portfolios. This tail risk hedge are options that are long between 1 DT and 14 DT. And then basically they're convex. So we do have a valley of death. Like if we're down 2%, we're basically just going to lose 2%. But if the market were to gap down 20%, we'd make like 15%. So for example, like this 10% basically happened when they shut down the economy in 2020. And another example that just recently happened is when Iran, I don't know, they did something with Israel, I forget what it was. But the VIX opened up 18% overnight and the futures were down 1.6%. While that was occurring, I was marking minus 3 basis points on the account. In the morning, the VIX opened up at 4% and the market was effectively break even. I opened up at plus 55 basis points. So that kind of shows you the robustness of the overnight hedge. However, you can't size this large because high premium capture usually lends to, a larger volatility, larger losses. But again, it pairs well. Then with this overnight strategy, relatively, again, small size, but the longs will be offset by the shorts. Then we have the zero DT mechanical, which is just getting that premium on each and every day. The reason I don't size this one up large is because, we have double stop risk, basically what that is. And there's not that many strategies that work basically no matter what. You can see here that the premium capture is much lower. Then when we go to the trend following strategy, when vol's coming out of the market, or when we're trending up strongly, this is predominantly, put selling or skewed condors. You can again see that we have a very high premium capture, but again, this doesn't happen every day, so we can't size it that large because if it does reverse against us, we'd be taking a large drawdown.
So on your hedging strategy, what's your DTEs? What's your DTE on your hedging strategy?
Between 1 and 14.
1 and 14.
I choose different ones basically to balance out vega and convexity of those trades.
So like stack them? Are you stacking your hedge? Like,
yeah.
Your entry?
So I'm taking daily entries to have straight delta exposure. I'm actually kind of glad you brought this up. So like people are predominantly worried about the 1 DT overnight strategy. So if the market were to gap down, the same thing's going to happen with the market makers. They're going to spike that bid ask to some ridiculous fictitious implied volatility for market orders. It could be 200%. However, when you're doing daily entries, let's say you're entering in with straddles, you're in the money. So even if the Chinese were to take over the stock market exchange and all the orders were lost, I know that regardless of what my account is marking at, I hold intrinsic value because I have straddles that are long, that are in the money more than my out of the money options. So that also further is another layer that prevents against fragility of risk, that irregardless what their rational price quotes on me, I know what my actual exposure is because I have long contracts that are in the money versus short contracts that are in.
So are you doing, I mentioned doing straddles. Do you ever do anything like butterfly or broken wing? Or
no,
you're pretty much straddle.
I just want the delta exposure closer to expiration. I want the vega exposure further out from expiration because again, with zero DT options, it's like I'm worried about the gamma risk, which could be offset by delta. And then I'm worried. And then the vega risk with the longer duration options will be the kicker that helps offset some additional, gamma risk that we take from the shorter duration options.